When you buy one share of Apple, you're not buying a phone or a laptop. You're buying a tiny slice of the entire company. Congratulations, you're now a part owner of one of the biggest companies on earth, even if your slice is microscopic. That ownership is also called equity, a word that simply means you have a claim on the company's assets and earnings. Think of equity like owning a seat at the table. The bigger your stake, the louder your voice, though for most of us, it's more like whispering from the back row. Now, where do you actually buy these stocks? That's where the stock exchange comes in. It's the marketplace, the arena where buyers and sellers meet. The New York Stock Exchange and NASDAQ are the big players, kind of like the Amazon and eBay of the investing world, except instead of buying gadgets, you're buying ownership in businesses. Every company on these exchanges gets a ticker symbol, a shorthand name that makes trading faster. Apple is AAPL, Tesla is TSLA, Google is Google. It's like a nickname, but for corporations. And all the stocks you own, whether it's Apple, Microsoft, or a random ETF you bought on a whim, those together make up your portfolio. Think of your portfolio as your investment recipe. Some people load up on spicy, high-risk stocks. Others prefer a bland but steady mix of bonds and index funds. Now, let's talk about the people and platforms that make all this possible. An investor is anyone putting money into assets with the hope of growing wealth over time. You don't need a suit or a corner office to be one, just a brokerage account and a plan. That brokerage is your gateway, the middleman or platform that actually executes your trades. Apps like Robinhood, E-Trade, and Fidelity have made it so easy that you can buy a stock while waiting in line for coffee. Many brokers today don't even charge a commission anymore. That's the fee they used to take for every trade. But don't be fooled. Free isn't always free. Some platforms make money in other ways, like selling your order flow or charging for premium features. It's worth knowing how your broker gets paid. Once you're in the market, you'll hear people talk about public companies and private companies. Public companies are the ones listed on exchanges. Their shares are available to anyone, and they have to play by strict rules, filing earnings reports and being transparent with investors. Amazon, Coca-Cola, Microsoft, all public. Private companies, on the other hand, keep their shares close to the chest. Think SpaceX or IKEA. You can't just buy a piece of them on your lunch break. They're owned by founders, employees, or a small circle of investors, and they answer to no one but themselves. Here's where it gets interesting. Some stocks pay you just for holding them. These payments are called dividends, a share of the company's profits sent directly to shareholders, usually every quarter. It's like getting a thank you note with cash inside. Coca-Cola, Procter & Gamble, and many big stable companies are known for this. But not every company pays dividends. Some, especially younger growth-focused ones, reinvest every dollar back into the business. The flip side of earning is losing. When you sell a stock for less than you paid, that's a capital loss. Bought at 100, sold at 80, you just lost 20 bucks. It stings, but it's part of the game. Even the pros take losses. What matters is what you do next. Understanding return on investment, or ROI, helps you measure success. If you invest $1,000 and it grows to $1,200, your ROI is 20%. Simple math, but incredibly useful when comparing different opportunities. And if you're earning dividends, there's another metric to watch: yield. If a stock costs $100 and pays $5 a year in dividends, that's a 5% yield. It's a quick way to see how much income your investment is generating. But here's the secret weapon that most beginners overlook: compound interest. It's not just earning money on your original investment, it's earning money on the money you've already earned. Invest $1,000 at 10%, you've got $1,100 after year one. Next year, you earn 10% on that $1,100, not just the original 1,000. Over decades, this snowball effect is how people build extraordinary wealth. It's not flashy, it's not fast, but it's unstoppable if you give it time. Let's get into the actual mechanics of buying and selling. A market order is the simplest move. Buy or sell right now at whatever the current price is. It's fast, it's easy, but you're at the mercy of the market. A limit order gives you more control. You set the price you're willing to pay or accept, and the trade only happens if the market meets your terms. If Apple is at $190 and you want it at $185, you set a limit order and wait. Then there's the stop loss order, a safety net. You set a price below where the stock is now, and if it falls to that level, It automatically sells to protect you from bigger losses. It's like having a parachute that deploys when things go south. A trailing stop is even smarter. It moves with the stock as it rises, locking in gains while still giving it room to grow. These tools aren't just for day traders, they're for anyone who wants to invest with intention instead of emotion. Now, not all stocks are created equal. Blue chip stocks are the steady giants, companies like Apple, Microsoft, Johnson & Johnson. They're not going to double overnight, but they're not going to disappear either. Growth stocks are the opposite. High potential, high energy, often high risk. These are companies expected to expand rapidly. Think Tesla in its early years or any hot tech startup. Then you've got value stocks, the bargain bin of the market. These are solid companies trading below what they're truly worth, either because they're out of favor or overlooked. Dividend stocks are for people who want income, not just growth. And cyclical stocks rise and fall with the economy. Think airlines and hotels. When times are good, they soar. When the economy sputters, they stall. Defensive stocks are the opposite, companies people need no matter what, like healthcare and utilities. Recession or boom, people still need electricity and medicine. Here's where the mood of the market comes in. A bull market is when prices are climbing and optimism is high. Everyone's feeling good, portfolios are growing, confidence is contagious. Picture a bull charging upward, horns pointed to the sky. A bear market is the opposite, prices falling, fear spreading, pessimism taking over. Bears swipe downward, just like the market in these times. A correction is a smaller dip, around 10%, and it's actually healthy. It cools things off when prices get too hot. A crash, though, that's the nightmare. Sudden, severe, panic-driven. Crashes can wipe out years of gains in days. Then there's volatility, how much a stock's price jumps around. High volatility means wild swings. Low volatility means steady, predictable movement. Some people thrive on volatility, others lose sleep over it. You'll also hear about market cap, short for market capitalization. It's just the total value of a company, calculated by multiplying the stock price by the number of shares. A company worth $1 trillion is large cap. One worth a few billion is mid cap. Under 2 billion, small cap. Size matters because it affects risk, growth potential, and stability. Speaking of numbers, here's one that gets thrown around constantly. The PE ratio, or price to earnings ratio. It compares a stock's price to how much profit the company makes per share. A high PE might mean investors expect big growth, or it might mean the stock is overpriced. A low PE could mean it's a bargain or that something's wrong. Context matters. Then there's the PEG ratio, which factors in growth. It takes the PE and divides it by the company's expected earnings growth rate. A PE under 1 can signal a stock that's cheap relative to its potential. Let me give you one more concept that changes everything. Diversification. It's the closest thing investing has to a free lunch. Instead of putting all your money into one stock, you spread it across many different industries, different asset types, maybe even different countries. If one investment tanks, the others can cushion the fall. It's not about avoiding risk entirely. It's about managing it intelligently. You can diversify through ETFs, exchange-traded funds, which bundle dozens or hundreds of stocks into one ticker, or index funds, which track entire markets like the S&P 500. You get instant exposure without having to pick individual winners. It's simple, effective, and historically, it works. The stock market isn't a mystery reserved for Wall Street insiders. It's a tool, a language, a system that anyone can learn. Once you understand the terms, the fog lifts. You stop feeling intimidated and start seeing opportunities. You stop guessing and start deciding. The market rewards those who speak its language, not with perfection, but with confidence and clarity. And now you're fluent enough to start your journey.